the problem is that as numbers get bigger, it takes more and more to move the needle.
Yeah.
But the upside of that is it's a more liquid network. So Bitcoin in 2025 is more liquid than Bitcoin in 2017. And I think a lot of that money is pretty sticky. So I would generally expect drawdowns to be controlled. But then upside, if you shoot upward really quickly, you do get a lot of selling pressure from older holders, like people that have been holding longer than are up significantly, either rebalancing or upgrading their house, like they're the quote unquote buying the Lambo. You do see some of that cycle. So I think it is healthier not to go straight up and to kind of go over time. The debt ceiling can affect liquidity. And as I covered in a report with Sam Callahan and other work, Bitcoin price actions historically pretty correlated with liquidity. It's not the only correlation, but it's one of the more sizable inputs to Bitcoin price in the intermediate term. And so the debt ceiling, basically ever since roughly World War I, instead of Congress micromanaging every treasury issuance, they say, look, the Treasury Department can do those details, but you can't go over this limit. And that's different from authorizing spending. This is basically just how they pay for spending that they do authorize with their other bills. It's kind of like whether or not the government's going to pay their previously agreed to bills or not. And for roughly a century, it wasn't really used by one party against another. But ever since the global financial crisis, it's a tool. Now we're in this age of more political polarization. It's a tool that can be used largely from the out of power party against the in power party, or at least whoever is president at the time. It can be used against them to extract some degree of negotiation. And if it's not lifted, you get technically the risk of a technical default. In practice, usually at the 11th hour, it's fixed. And we have a fairly small sample size because it's only been used since the global financial crisis. Usually it's used against Republican Congress, against a Democratic president. But that's partially because most of the years after the global financial crisis have been run by a Democratic president. Democrats didn't really use it against Trump in his first term. And we've not really seen like intra-party usage. This, if it's used here, and so far it is a little bit, if it's used here, it would be the first time, at least in modern history, where the Republican Party is using it against the Republican president. And so if they do enforce it and they try to extract concessions, then essentially the Treasury cannot issue net new debt. They can't increase the total debt load. To the extent that some are due, so they pay out, to existing maturing debt, and they can issue some new debt to kind of offset that, but they can't increase the total amount. And so they have to start taking what they call extraordinary measures. And that's the date that matters for January 21st, because the outgoing Treasury Secretary Yellen and her team estimated that the 21st is when they basically run into the actual debt ceiling and have to start shuffling their books around to keep things operating without issuing new debt. And the part that's relevant is that if this starts going on for weeks and months, they have to start draining their cash balance back into the financial system. So at any given time, the Treasury has a Treasury General account. It's their big checking account at the Fed. There's something like $650 billion in it right now. And if they can't issue debt, but they still have bills to pay, they can start draining their cash balance. And that's how they can keep running things for several more months. The last time this happened was the first half of 2023. And that, ironically, when the TGA is drained, it's actually pretty good for liquidity because all that money is draining back into the financial system. Excess.
Is that almost like QE?
It's kind of like QE, yes. And so they can offset quantitative tightening with that unintentionally. And any excess liquidity from that will probably spill into the reverse repo facility. But yeah, that's basically all pro liquidity. And so that actually can be decent for asset prices. The risk comes, first they have to get past the debt ceiling impasse, but then when they actually go to refill the cash balance is when they could run into liquidity problems. So my base case is that this won't be a protracted one because we've never really seen an intra-party dispute get really protracted like this. but it's not out of the realm of possibility. Trump wanted the debt ceiling resolved before he took office. That didn't happen, and so now he has to solve it in office, but he has the benefit of his own party to work with. The initial point was to not have to micromanage Treasury issuance. So it's a law that made sense a century ago. So before World War One, the U.S. government was simple enough that literally Congress could kind of micromanage Treasury issuance. That eventually got too big, too bureaucratic, too much going on, so they can't micromanage it. They say, okay, Treasury Department, do it. Just don't go over this number. And that's how we've been operating for like a century now. And it doesn't really make sense because it's not about allowing more spending. It's about whether or not you're going to pay the bills that you are already authorized. So Congress, which authorized prior spending, is now authorizing a debt ceiling increase to finance the spending that they've already authorized. That's the part that doesn't really make sense. And that's just basically an historical artifact that just is kind of the way things work. And yeah, it's mostly theater. And technically, if you had a really entrenched argument, you could run that into a technical default. And so it does put some pressure on the president to do things. But like I said, intra-party probably means less pressure, but we'll see.
So do you think they're going to have to dip into the Treasury General account in the sort of short term?
If weeks start going by, yes. There's actually already been a slight dip into it. So their current target is to have 700 to 850 billion in their account, and they dipped under 700 billion. Now at year end, at the end of every quarter, and especially at the end of the year, there tends to be liquidity strain in the system, like literally the last couple days of a quarter. It's possible that they dipped it a little bit to kind of boost liquidity for that few day period. I'm not otherwise sure why they dipped below their 700 billion figure. So they're already a little bit dipped. But yeah, basically every week that starts going by, generally that has to start being drained. Now, any given kind of multi-week period, so if you have 2 to 3 weeks, bills go out regularly, debt matures irregularly. So not every week is going to be signal, but as you get into February, March, April, May, if there's no debt ceiling resolution, then that we should start to see that cash balance drain. There's domestic liquidity and global liquidity. If you focus on domestic liquidity, there's basically a handful of big moving parts that determine what's happening with liquidity. So one is the central bank increasing or decreasing the monetary base. Basically, quantitative easing is pro-liquidity, quantitative tightening is anti-liquidity. Then there's other sources of liquidity. So because they did a ton of excess QE, a lot of excess liquidity was created, even more than the financial system could take. And so a lot of that was stuffed into reverse repos. That's kind of like a black hole of like excess liquidity, or a void to kind of put it there temporarily. And as they've done various anti-liquidity options, some of that is actually starting to come back out into the system. It's kind of like a buffer. So that as the reverse repo facility is drained, pro-liquidity, and then the TGA is filling it is negative for liquidity, draining it is positive for liquidity because it goes back into the system. So all those things kind of affect. One way to think of it is that if the government's spending but they're not issuing new bonds to do it, then they're spending money into the system and not really extracting money from the system. That's kind of juicing up the system. On the other hand, if they're borrowing money but they're not spending it yet, they're pulling liquidity out of the system and holding it in this void, their TGA, that they're not recycling back in yet. And so that can tighten financial conditions. The other things are harder to pin down, but it's like credit availability. So are banks tightening loan standards to various businesses and consumers, making it harder to get a loan than they were a quarter ago? Or are they easing their lending standards? They're more optimistic. They're a little bit more relaxed. That affects basically day-to-day liquidity for businesses and people. And of course, interest rates also factor into that as well. And then when we take a step back and look at global liquidity, a really big component there is the strength of the dollar relative to other major currencies. And the reason for that is because around the world, especially in emerging markets, but this is all intertwined globally, you'll have a lot of borrowing in dollars. And it's not even usually the U.S. entities making those loans. Like literally a firm in France could make a loan in dollars to a borrower in Brazil. It's because the dollar is global reserve currency. And the problem is that when the dollar strengthens significantly, all those liabilities basically increase in value relative to all these entities' cash flows. It could be a sovereign entity, it could be a corporate entity, and they start getting squeezed. And if that happens, a lot of these areas with dollar liabilities, not all of them, but a lot of them have dollar assets as well. Now, on average, the world has a lot more dollar assets than dollar liabilities, and so they can start selling dollar assets. Could be treasuries, could be stocks, and then getting dollars to service their dollar debts. So if a company in, say, Brazil has a dollar shortage, Brazil, as a sovereign entity, could help it. And it could be selling some of its reserves to get dollars to do that. And so generally, any
Hmm.
sort of spike in the dollar strength is pretty negative for liquidity when it happens, at least as one really big variable.
So that's why when, say, the Dixie's going up, the dollar's getting stronger, Bitcoin tends to underperform.
On average, yes. There's other components, but yes, that is a generally a pretty big headwind against a lot of assets, and Bitcoin happens to be the one that's probably the most correlated with liquidity of any other asset that I track.
Why do you think then in the last few months the dollar's been doing quite well while Bitcoin has also been doing well? What's different this time?
I think the election outcome is a
Hmm.
big difference. So, like I said, it's not the only impact. So it's not been a great few months for global liquidity. But when you have a major election outcome like that, that impacts the industry more than other things. So it basically a strategic Bitcoin reserve went from 0% under if the other administration would have won to some number that Polymarket is trying to guess. We don't know what the chances of a strategic Bitcoin reserve are. Maybe by the time this airs, there'll be an executive order. I don't know. But so as of this moment, we don't know the odds, but they've suddenly increased a lot more than zero. Other kind of pro policies for the industry have also shifted upward. And so all of that had to be kind of priced in. And I think that was a bigger positive force than what is a fairly small liquidity drain. So the dollar going up was not great for liquidity, but we're talking, single digit percent change in global liquidity.
What do you think all of that means for Bitcoin in the next 12 months?
I mean, generally, there's a bunch of variables. So the combination of ongoing fiscal dominance is pretty good for Bitcoin. Um, Tariffs or anything that could reduce liquidity. So tariffs, a dollar spike, that's around the margins negative for Bitcoin. So I would expect probably some of those events happen this year. They're probably not sustained for very long. Kind of negative liquidity is not really, it's hard to sustain for long periods of time given how levered the system is. Um, the policy mix is probably neutral to bullish for Bitcoin. And then when I look at certain on-chain things, like really basic stuff like market value relative to cost basis, or the HODL wave, like what percentage of coins haven't moved in a year and how many of them sold into the bull market, because bull markets are characterized by the market value getting way ahead of the cost basis, and are characterized by some of the older coins that are up 5, 10, 20x selling into the new buyers. So I look at those types of indicators to see, are we stretched here? And both of those still look kind of mid-cycle. Now, cycle structure could change, so there's no guarantee, but most signs to me still point up. 12 months, anything can happen, but if I say 12, 18, 24 months, I'm still pretty bullish on Bitcoin at these.
Welcome back to the Market Chronicles, your guide through the twists and turns of the financial world.
And this is episode number 5 already.
Time flies when you're deep diving into market trends. And today, we're going deep on Bitcoin.
Taking a close look at some recent insights from Lyn Alden, a macro analyst who always has her finger on the pulse.
Absolutely. For our viewers on YouTube, make sure you hit that subscribe button so you don't miss out on future deep dives.
All right, so Lyn Alden, she's been talking about Bitcoin's liquidity and how it's changed over time.
It's interesting, right? Bitcoin's market cap is way bigger now than it used to be.
Yeah, much larger. But she points out that it actually takes more to move the price now.
Which kind of implies more stability, wouldn't you say?
Exactly. It suggests there's less volatility than there was before.
So what's driving this shift?
Well, Alden talks about this concept of sticky money.
Sticky money.
It basically means that a growing portion of Bitcoin holders are in it for the long haul.
These are the folks who aren't spooked by short-term price swings.
Right. They believe in the long-term potential of Bitcoin, and they're not selling at the first sign of a dip.
So how does this stickiness impact potential price moves?
Well, think about it. A sharp rise in price might trigger some of these long-term holders to, you know, buy the Lambo.
Cash out a bit, right?
Yeah, take
Yeah.
some profits. But on the flip side, if there's a price drawdown, those dips might be more controlled.
Because the sticky money folks are holding strong.
Exactly. Now, let's bring in another piece of the puzzle that Alden's been talking about. The whole U.S. debt ceiling drama.
Oh, yeah, that's been heating up lately.
The debt ceiling, just to clarify for anyone who's not familiar, it doesn't authorize new spending. It's about the government being able to pay for spending that's already been approved by Congress.
It's like agreeing to buy a car and then refusing to pay the bill once it arrives.
Right. It's about meeting existing obligations. But in recent years, it's definitely become a political football.
Every time we get close to hitting the ceiling, it feels like a game of chicken in Washington.
And, if the debt ceiling isn't raised and the government can't issue new debt, they might have to resort to using the Treasury General Account. That's the Treasury's account at the Federal Reserve.
The TGA, as it's often called.
Right. They might have to drain that to keep things running.
But here's where it gets interesting. Draining the TGA could actually pump liquidity into the financial system.
Yeah, mini QE, almost.
As the Treasury uses those funds, they flow back into the economy.
Which brings us back to Bitcoin, because as Alden points out, Bitcoin's price has often shown a strong correlation with liquidity, particularly global liquidity.
So a potential TGA drawdown could, at least temporarily, be a positive for Bitcoin.
Potentially. But we also have to consider the strength of the U.S. dollar.
The dollar has been on a tear recently.
And a strong dollar can actually lead to tighter global liquidity.
How so?
Well, a lot of borrowing, particularly in emerging markets, is done in U.S. dollars. When the dollar gets stronger, those debts become more expensive to service in their local currencies.
So they need more dollars to make those payments.
Exactly. And to get those dollars, entities in emerging markets might sell off their dollar-denominated assets, like U.S. Treasury bonds.
Which can put downward pressure on global liquidity.
Right. And that can have ripple effects across financial markets.
Including Bitcoin. So we've got this seemingly contradictory situation where both the dollar and Bitcoin have been performing well recently.
Which seems to go against the usual pattern.
Alden's theory is that the recent U.S. election and the potential for more Bitcoin-friendly policies might be offsetting those negative liquidity effects from the strong dollar.
So the political landscape is playing a significant role here.
Absolutely. It's this intricate dance between Bitcoin, the dollar, and global macroeconomics.
And it raises some interesting questions about whether this dynamic will continue.
Is this the new normal or just a temporary blip? It's something to keep an eye on for sure.
Now let's zoom out a bit and think about the bigger picture of liquidity.
Okay, so we're talking about more than just the TGA and QE.
Right. There's domestic liquidity, which is heavily influenced by the Fed, with things like QE and QT.
Quantitative easing and quantitative tightening. Those are the big levers they use to adjust the money supply.
Exactly. And then you have things like the reverse repo facility, which acts as a bit of a buffer for excess liquidity.
That's like a parking lot for cash that banks don't want to lend out right now.
A good analogy.
Yeah.
And the Treasury's actions also play a role here.
Like how they manage the TGA.
Right. Government spending without issuing bonds to cover it basically injects liquidity. But when they borrow money and just sit on it in the TGA without spending it, that sucks liquidity out of the economy.
It's like a game of financial musical chairs.
Kind of.
Yeah.
And then there's the availability of credit.
How easy or difficult it is for businesses and consumers to get loans.
Exactly. Easy credit means more money flowing around, which boosts liquidity. But when lending tightens up, it's like hitting the brakes.
Makes sense. And what about interest rates? Don't they impact liquidity too?
Absolutely. Higher interest rates usually mean higher borrowing costs, which can put a damper on liquidity.
It's a tough balancing act for central banks, trying to keep inflation in check without choking off economic growth.
For sure. Now, on the global liquidity side, Alden really emphasizes the importance of the U.S. dollar.
We talked about that a bit earlier, how a strong dollar can actually lead to a contraction of global liquidity.
It all comes down to the fact that a lot of borrowing, especially in emerging markets, happens in U.S. dollars. When the dollar strengthens, those dollar-denominated debts get more expensive to pay off in their local currencies.
Because they need to buy more of their own currency with those dollars just to cover the debt payments.
Right. So what happens? Entities in these emerging markets might start selling off their dollar-denominated assets. things like U.S. Treasury bonds.
To free up dollars to make those debt payments.
Exactly. And that selling pressure can have a ripple effect, leading to tighter global liquidity.
And potentially impacting Bitcoin's price.
Precisely. It's one of the reasons why we often see an inverse correlation between a rising dollar and a weaker performance in assets like Bitcoin that are really sensitive to global liquidity conditions.
So Alden points out this recent paradox where we've seen both the dollar and Bitcoin doing well.
Which seems to go against the grain.
Her take is that the recent U.S. election and the possibility of more Bitcoin-friendly policies might be counteracting those negative liquidity effects we usually see from a strong dollar.
At least for now. It just goes to show that there's always more than one factor influencing Bitcoin's price.
It's a web of interconnected forces. But Alden doesn't just leave us hanging with all this complexity. She does offer a cautiously optimistic outlook for Bitcoin over the next 12 to 24 months.
She sees this fiscal dominance trend, with governments spending more than they're bringing in, as a potential tailwind for Bitcoin.
But she also acknowledges there are some potential headwinds out there, right?
Yeah, things like ongoing trade wars and the possibility of the dollar continuing to strengthen, those could create some challenges.
But she doesn't seem to think those negative factors will have a lasting impact.
And she views the policy landscape in the U.S. as being anywhere from neutral to potentially bullish for Bitcoin.
Especially with the possibility of more favorable regulations under the new administration.
Now, Alden also puts a lot of emphasis on these on-chain indicators.
What are those exactly?
They're metrics that give us a glimpse into the behavior of Bitcoin holders and the overall health of the Bitcoin network.
Sort of like checking Bitcoin's vital signs.
A good way to put it. And metrics like the market value to cost basis ratio and the percentage of unmoved coins suggest that Bitcoin is still kind of in a mid-cycle phase.
Meaning we're not seeing signs of it being overextended or near a major peak.
Exactly.
So the message here seems to be that while short-term volatility is always a possibility, Alden's analysis suggests a pretty positive long-term outlook for Bitcoin.
That's right. She believes the fundamental factors supporting Bitcoin are still strong.
Of course, predicting the future is never a sure thing, especially in the world of crypto.
But Alden's insights, based on her understanding of macroeconomics and the Bitcoin ecosystem, do provide a helpful framework for thinking about what might be ahead.
She's definitely putting her money where her mouth is, so to speak, by remaining bullish on Bitcoin's prospects.
And this view is shared by a lot of other analysts who believe that Bitcoin is still on a path of long-term growth.
Even with the inevitable bumps along the way. So what does all this mean for you, the listener? What questions does this raise for you about Bitcoin and how it fits into your own investment strategy?
It's definitely something to think about. Here's a final thought for you to ponder. We focused on Alden's insights today, but what other factors beyond the ones we discussed could influence Bitcoin's price in the coming months?
Could emerging technologies play a role? What about changes in regulations? Or even some kind of unexpected geopolitical event?
The world of finance is always full of surprises, and that's what keeps things interesting.
That's the beauty of it, right? There's always something new to learn and explore.
Absolutely. Keeps us on our toes.
So to wrap things up, it seems like Alden is painting a cautiously optimistic picture for Bitcoin.
Yeah, she sees the potential for continued growth, but she's also realistic about the risks and uncertainties out there.
And it's important for all of us to keep those in mind as well. No matter how bullish we might be on Bitcoin, or any asset for that matter, it's crucial to do our own research.
Absolutely. Understand the risks. Think about your own investment goals and your own risk tolerance.
Don't just follow the hype.
Yeah.
And if you're looking for a deeper dive into these topics, I highly recommend checking out Lyn Alden's work.
She's a fantastic resource. A lot of great insights there.
Well, that brings us to the end of another episode of the Market Chronicles.
Thanks for joining us on this deep dive into Bitcoin and liquidity.
And for those of you watching on YouTube, make sure you hit that subscribe button and the notification bell so you don't miss any future episodes.
We'll be back soon with more deep dives into the financial world.
Until then, happy investing.